Something just broke in China. Not the price, not the chart, something deeper, something that tells you the game has changed. While Western markets celebrate new highs and analysts debate whether this rally has legs, the world's largest consumer of silver just lost control. The Chinese government, the entity that manages 1 billion people, that controls capital flows with an iron fist, that can shut down entire industries with a single directive, just admitted it cannot control the silver market. And that admission came in the form of a trading halt. The UBS SDIC Silver Fund, China's only pure-play silver investment vehicle, suspended trading. Again. The fund that has issued 15 separate risk warnings since the start of the year. 15 attempts to tell investors to slow down, to be rational, to understand that what they are doing is unsustainable. Nobody listened. So they pulled the plug, they stopped the trading. And the premium, the spread between what people were paying for this fund versus the actual value of the silver it holds, hit 68%. Let me say that again. Investors in China were paying 168 yuan for 100 yuan worth of silver. They were bidding up a paper wrapper to levels that defy mathematics. This is not speculation. This is not a bull market. This is panic. This is the end game of a supply shock meeting a cultural obsession with hard assets. And it is getting worse by the hour. You have to understand what a premium means in this context. When you buy shares of a silver fund, you are buying a claim on physical metal stored in a vault or represented by futures contracts. The net asset value of that fund, the NAV, is calculated by taking the market price of silver and dividing it by the number of shares. That is the fair price. But in China, the trading price of this fund disconnected from reality. It started the month at a 7% premium. Annoying, but manageable. By mid-month, it was 20%. The fund managers issued warnings. Investors ignored them. By last week, it was 40%. The fund restricted new subscriptions, limited daily purchases to 100 yuan per person. The premium kept climbing. By yesterday, it was 68%. At that level, you are not investing. You are gambling that someone else will pay an even more insane price tomorrow. You are playing musical chairs in a burning room. And the Chinese regulators, watching this in real time, decided the music had to stop. So they hit the emergency button. Trading halted. No buying, no selling. Frozen. But here's the thing. The halt does not solve the problem. It just proves the problem is real. If this were a normal market with normal supply and normal sentiment, a 68% premium would never exist. Arbitrage would crush it instantly. Smart money would create new shares, sell them into the market, pocket the spread, and the premium would collapse back to zero. But that is not happening. Why? Because even at a 68% premium, there are not enough shares to meet demand. The fund cannot create new units fast enough because the underlying silver futures market is itself constrained. The Shanghai Futures Exchange is running low on deliverable metal. The vaults are being drained. Every kilogram bar that gets allocated to this fund is a kilogram bar that is not available for industrial use. And industrial users are screaming. This is where the story gets darker. This is where we move from financial absurdity to real-world consequences. In Shenzhen, in the Shuibei district, which is the heart of China's jewelry and precious metals processing industry, something unprecedented is happening. Factories that have spent decades crafting intricate gold necklaces and silver bracelets have stopped. They are not making jewelry anymore. They are making bars. 1 kilogram silver bars. Investment grade. Serial numbered. Packaged. Why? Because the premium on finished jewelry has collapsed while the premium on raw bullion has exploded. A factory can make more money melting down their silver inventory and casting it into bars than they can selling finished product. Think about what that means. The jewelry industry, an industry that adds value through labor and craftsmanship, has been turned into a smelting operation because the raw material is worth more than the art. This is a supply crisis made visible, and the buyers lining up for those bars are not institutions. They are not hedge funds. They are retail. They are individuals. Videos circulating on Chinese social media show crowds at Shuibei at midnight. Not during business hours. Midnight. Shoulder to shoulder, pressed against delivery trucks, waiting for the next shipment. One video shows silver bricks, industrial slabs meant for processing, stacked upright on the street, not in a warehouse. On the street, being counted by hand, being sold on the spot. No invoices, no standard procedures. Just cash for metal and get out of the way because the next buyer is pushing from behind. Another video shows a line stretching around a city block. These are not speculators. These are ordinary people who have decided that holding yuan is more dangerous than holding silver at any price. They have watched the government restrict capital outflows. They have watched the property market collapse. They have watched the stock market gyrate wildly. And they have concluded that the only safe asset is the one they can hold in their hand. But even this frenzy, even this street-level panic is not the full story. Because at the same time this is happening, something even stranger is occurring in the financial system. Another platform, a gold trading platform in Shenzhen, is in crisis. Investors are protesting. They cannot withdraw their funds. The local government has set up a special task force to investigate. Over 350 people are waiting for compensation from a silver dealer that defaulted. Defaulted. Not delayed. Defaulted. Could not deliver the metal. Took the money and does not have the bars. This is what happens when a market that operates on trust and leverage suddenly faces a demand shock that exposes all the lies. For years, these platforms operated on fractional reserve. They sold 10 claims for every 1 bar in the vault. Nobody cared because nobody took delivery. It was a paper game. But then the export ban hit. Then the industrial users panicked, then retail woke up. And suddenly, everyone wants their metal at the same time. And there is not enough. The local industry association issued a warning as early as October. 3 companies were flagged. Nobody paid attention. Now the defaults are spreading. Now the Luohu district government is stepping in, but you cannot regulate metal into existence. You cannot print silver bars. The Chinese government is learning the same lesson the Federal Reserve learned with gold in 1971. When the physical demand overwhelms the paper supply, the paper breaks, and we are watching it break in real time. The UBS SDIC Fund trading halt is not just a regulatory timeout. It is an admission that the system cannot handle the flow. Even with purchase limits of 100 win per day, even with 15 risk warnings, even with the fund managers literally begging people to stop. The demand is so intense that the only option left is to shut it down. And shutting it down does not reduce demand. It redirects it. If you cannot buy the fund, you go to Shuibei at midnight and buy a bar. If you cannot get a bar in Shenzhen, you go to Shanghai. If you cannot get it in Shanghai, you pay the premium and import it, except you cannot because the export ban is in effect. You are trapped in a closed loop. 1 billion people with savings, a government that does not let you move money offshore, a property market in ruins, a stock market you do not trust, and one tangible asset that has been going up every single day for months. What do? You buy silver at any price. Because the alternative is holding depreciating paper. And this is where the math becomes terrifying for the global market. The premium in China is not a local anomaly. It is a signal. When Shanghai trades silver at a $10 to $15 premium over London, the market is screaming the official price is wrong. The COMEX price, the LBMA price, these are paper prices, the price of a promise to deliver. But in China, in the real world, where factories need metal to build solar panels and batteries, the price is $15 higher, and rising. This spread should not exist. If silver is $10 cheaper in New York than Shanghai, every bank should be buying in New York and selling in Shanghai. Risk-free profit, but they cannot. The export ban means you cannot get metal into China without a license, and licenses are not being issued. The door is closed, so the Chinese market is an island. And on that island, the price is determined by local supply and demand. Local supply is 0 now. Demand is infinite. This is the nightmare scenario that the commodity analysts have been warning about for years. A bifurcated market. One price for paper, one price for physical, and a growing recognition that the paper is worthless if you cannot convert it to metal. The Chinese retail investor has figured this out. They are not buying futures. They are not buying ETFs. They are buying bars. And when the bars run out, they're paying 68% premiums for a fund that holds futures. But here is what nobody is talking about. China is the world's largest fabricator of silver products. They import raw silver, refine it, turn it into components, and export finished goods. Solar panels, batteries, electronics. If Chinese factories cannot source silver domestically and they cannot import it because of the export ban, production stops. The solar panel factories that power the green energy transition run out of feedstock. The battery plants building EV cells hit a wall. The electronics manufacturers supplying Apple and Samsung face shortages. This is not a financial problem anymore. This is a supply chain fracture. Reports are surfacing of factories switching from jewelry to bar production. That is phase 1. Phase 2 is when those factories realize they cannot get any silver at all and shut down. Phase 3 is when Western corporations realize their supply chain is dependent on a metal they took for granted. Phase 4 is when those corporations enter the market as panic buyers, bidding against Chinese retail, bidding against fund managers, bidding against each other. We are in phase 2. The 68% premium is phase 3 arriving. And the trading halt, the regulatory intervention, the government task force in Shenzhen, these are all signs that the authorities know it. They know they are losing control. They know that no amount of warnings or restrictions or trading halts will stop a population that has lost faith in paper and wants metal. So what happens next? The fund will resume trading eventually, maybe tomorrow, maybe next week, and when it does, the premium will still be there. It might compress slightly because some weak hands will panic sell, but the underlying demand has not changed. The export ban is still in effect. The vaults are still empty. The industrial users are still desperate. If anything, the trading halt will make it worse, because now everyone knows the government is scared. And when the government is scared, that is when you really panic. The smart money in China is not waiting for the fund to reopen. They are in Shui right now. They are buying bars. They are taking delivery. They are moving metal out of the system and into private hands where it cannot be rehypothecated or leased or lent. Every bar that leaves the vault is a bar that cannot be used to settle 10 paper claims. The leverage is unwinding. The fractional reserve is collapsing. And the Chinese government, for all its power, cannot stop it. Because you cannot print silver. This is the fundamental constraint that breaks every manipulation scheme. The London Gold Pool in the 60s, the Hunt brothers in the 80s, the comic silver short in the 2000s. Every time, the same pattern. Suppress the price with paper, lever up the system, rely on the fact that nobody takes delivery, and then one day, everyone takes delivery at once. And the scheme implodes. We are watching the implosion. The UBS SDIC Fund is the canary. The 68% premium is the smoke. The Shenzhen defaults are the fire, and the midnight queues at Shui are the evacuation. What does this mean for the price? If China, with all its regulatory power, cannot keep a lid on domestic demand, even at a 68% premium, what happens when that demand spills over into the global market? What happens when Chinese buyers, unable to access metal domestically, start bidding on London and New York? What happens when the premium in Shanghai forces the COMEX price to reprice upward just to prevent a complete arbitrage breakdown? We are about to find out. Because the export ban is permanent, the supply shock is structural. And the Chinese retail investor, having watched their property wealth evaporate and their currency devalue, has decided that silver is the only answer. They're not wrong. They are just early. And the 68% premium they are paying today will look like a bargain when the global market realizes what they already know. There is not enough metal. There has never been enough metal. And the paper game is over. The trading halt is not the end of the story. It is the beginning of the end game. When even the Communist Party cannot control the price of silver, when even the threat of regulatory punishment cannot stop the buying, when even a 68% premium is not enough to ration demand, you are no longer in a bull market. You are in a shortage, a real, physical, undeniable shortage. And shortages do not resolve with price corrections. They resolve with supply destruction or demand destruction. And in China, the demand is not being destroyed. It is accelerating. The fund will reopen. The premium will persist. The defaults will spread. And the world will wake up to the fact that the most critical industrial metal of the 21st century is being hoarded by 1 billion people who have lost faith in everything else. While the West watches charts, China is emptying vaults. While analysts debate technical levels, factories are shutting down. While regulators issue warnings, midnight queues are forming. The 68% premium is not irrational. It is the market telling you the truth. And when you cannot get it anywhere else, when the vaults are empty, when the government has closed the borders, you pay what you have to pay. And China is paying. The question is, when will the rest of the world start paying attention? Now.